When you think of the JSE and you think of the extraordinary performance over the last 6 months or so, in fact since June the 4th and beyond there, you think of retail and you think of local industrials, but what about the listed property sector of the JSE? It's had a phenomenal run, and a company has just come out with its full year results today. It's called the Rebosis Property Fund Limited. In the Joburg Power Lunch studio is Sisa Ngebulana, who is the CEO of that fund. Sisa, thanks so much for joining us this lunchtime. Looking at your numbers, and actually more importantly, because you're going to go through the numbers with me, I like your commentary. You say you own a high growth defensive portfolio of 12 properties. High growth and defensive, so you get the best of both worlds. It's fantastic.
Indeed. Indeed.
Tell us about the numbers over the last year, though. You've got an 85.5% total distribution per linked unit and a 31.5% return to shareholders. Tell us how you've achieved that.
Thanks. We've had a good year. We are quite proud of our results. It's been an exciting year. Collective effort by my team to deliver these results. We are 12.1% up on distributions, which is pretty much almost double the sector average, which is quite a commendable result. As you say, 85.5 cents. It's in line with the focus range that we gave and just above the analysts' consensus. We've seen in the reporting year share appreciation of 39%. We've also had an asset growth of about 34.5% across the portfolio. I think what's also exceptional is the fact that, given the fundamentals that we have, as you mentioned, defensive and yet high growth portfolio, we see our vacancies at 2% as we speak, which is well above the sector average vacancies. In fact, almost threefold better than the sector. The portfolio is defensive in the sense that, let me talk about the retail. Our retail, we invest in dominant regional shopping centres with a high concentration of national tenants. And that bodes well from a defensive perspective. From the office portfolio, we have offices that are leased largely to government, which is a very good defensive sovereign underpin to our income. And that shows in the results effectively. And that's why we're able to be above the sector.
Let's just go back to your 12 properties, and you talk about retail, and it's almost 50-50 split, isn't it? 52% retail,
yes,
and 48% office. The retail side of things, of course, the retail story has been a fantastic story from a JSE perspective, as has the listed property sector, as I said in my introduction. There is, of course, a slight sort of overhang potentially in the future with inflation rising and potentially therefore interest rates rising and therefore the South African consumer coming under pressure. When you look at that 52-48% split, do you think that you've got the ability or indeed the will to maybe change that split in favour of another sector, for example offices or even commercial, due to the prospective economic conditions in South Africa?
Thanks. I think quite to the contrary, we actually want to grow the retail side. Again, because we invest in very good retail, which is dominant regional centres. They've shown resilience and exceptional qualities in terms of, in tough times. So we don't really invest in small retail, which tends to be affected, when the cycle turns. So, regional shopping centres generally have always, stayed the test of time. So we focus on that, and I think with the development pipeline that we have a first right of refusal in the Billion Group stable, it's that kind of development pipeline on dominant regional centres that we're hoping, at the right price and subject to our unit holder consent and running the process through independent board, we would have into the fund at a later stage. So we are looking at the fund perhaps, are growing to about 2/3 retail in the medium term.
Okay, so you're going to increase your retail exposure. What about the development pipeline, and what about your critical mass? You've got 12 properties at the moment. You've got a certain market cap, which is of course growing as the share price goes up, which is fantastic. But where would you like to see yourself? How many properties? What sort of market cap? What are your aspirations?
I think given that we invest in large properties, I think at a value of 4.5 billion for our total properties, 12 properties, the average out there in the sector would be perhaps about 80 properties for an equivalent value. So it just gives you a perspective. We invest in large properties. They're easier to manage and easier to look after, and yet they're defensive and they offer potential upside. I mean, if you take our shopping centres, there are only 3 regional shopping centres, as you say, making up 52% of the income, with Hemingway's being the largest centre. You know, it's something that we would stay in line with. I mean, we want to grow this portfolio in the medium term, which is a 5-year horizon, to about 10 billion cap. And in line with that strategy, investing in those defensive, large, dominant centres and offices which are, large. I think our investment criteria is we won't invest in less than 10,000 square metre offices, and from a retail perspective, won't invest in less than 20,000 square metre centres, unless the exception is if they have legs to grow into a regional dominant centre. And the location is right from an accessibility, access and egress, visibility, etc., from main roads and so on.